So there are 3 huge moves that you can make at the 100K income level that are going to help you save and grow your income further. The first move here is to automate your savings before you even see the money. And this is a system I want you to follow, and it's called the reverse budgeting system. That's where you start by setting aside your savings first every time you get a paycheck. So for example, if your monthly income is $6,000 and you want to save $600, you would set that $600 aside before doing anything else. Then you can use the remaining $5,400 for all of your other expenses. Now the trick here is to automate it so that you can't spend it at all, the savings that is, or that it doesn't even hit your account. And in this way, you won't even need a real budget because you've already reverse budgeted already. Now, in terms of how much you should be saving, I always like to aim for a 15% savings rate. That means if you are making $6K a month, maybe aim for $900 in savings. However, if you're finding that, say, your current savings rate is only 3% or 5%, you may have to start with a more attainable goal like a 10% savings rate first. In addition, the next time you get that paycheck, make sure the savings you set aside is automatically being moved into an IRA, a backdoor Roth, a high yield account, or even a brokerage account. If you're able to save and invest 15% of your take-home pay, so maybe $900 on a $6,000 a month salary, that's the equivalent of $10,800 per year. Starting at the age of 30, if you're investing this by the time you're 65, you'll still end up with over $2 million. The second big move at the 100K level is one that I haven't talked about too much, and that is considering to start an HSA or a health savings account. In this account, you can invest, but you can also pay for qualified medical expenses, and it's actually one of the most tax-efficient savings vehicles because it offers what's called triple tax benefits. First, contributions are tax deductible, which means that lowers the total amount of income tax that you pay in any given year. Second, the growth of this account is tax-free, just like the Roth IRA. And third, withdrawals for qualified medical expenses are tax-free, and that's the key. Now, you must be enrolled in a high deductible health plan to get an HSA, but these plans are actually pretty popular. So for the majority of you out there, you should be able to enroll. The 2026 contribution limit is around $4,400 for individuals and $8,750 for families. Now, here's the strategy with this. You want to max out the HSA, you want to invest the funds within the HSA, and then you want to pay your medical bills out of pocket and save the receipts. I know that sounds pretty weird. Why would you pay your medical expenses out of pocket when you just started an HSA? Well, that's because there is a loophole. There is no time limit on reimbursing yourself. So that means you can reimburse yourself against your HSA in the future. So pretend you contribute $4,000 into your HSA. You invest that money, it compounds at 8% for 30 years, and in 30 years, that's worth about $40,250. Meanwhile, over the same 30 years, you're paying your medical bills out of pocket with your regular money, and you're saving all the receipts. So let's say at the end of the 3 decades, you have receipts for $1,500, $2,000, and $3,000. That's $6,500 of expenses that you've never reimbursed yourself for. Well, when it comes time, 30 years later, you can hand yourself those receipts and pull $6,500 out of the HSA completely tax-free, no questions asked. And for the other $33,000 in there, it's still there for medical costs, or after the age of 65, it just starts to be treated like a traditional IRA as well, and you can withdraw it from there too. In other words, it's like you've turned your HSA into an extra retirement account. You still got the tax deduction going in, it grew tax-free the whole time, and it comes out tax-free for medical expenses, and you can save the receipts so you can decide when you want to take that cash out. All right, financial move number 3 at the 100K income level is to know your number. At 50K, the question is, am I going to be okay this month? But at 100K, I think the question then becomes, when am I done? When am I going to be financially independent? The number here is easy to calculate. It's how much you spend in a year times 25, and that's the 4% rule written another way. If you spend 60K a year, your number is going to be 60K times 25, or about $1.5 million. Now, the moment you know this number, every financial decision will get a lot easier because you can work backwards and figure out how long it's going to take you to financial independence. Now, the fascinating part about finance and personal finance is that your retirement date depends basically on your savings rate and not your income.